Thank you very much. I'm aware we're running already half an hour late, so either you can have Dorab now, or maybe I'll try and be reasonably quick. Actually, I didn't choose this title, so I thought I would, having been given it, I might as well do what I was asked to do. So I'm going to start off actually by looking at commodity price cycles, but I hope I won't take too long. I'm going to turn to El Niño. Some of what I might have done, I think, my colleagues and I work together with Ling Ah Hong, who spoke yesterday about weather. I leave all the nice photos to him, but I'm going to try and examine how this El Niño compares with earlier ones and how it's affecting CPO output. Then I'm going to come to what many people have talked about, palm oil production. One interesting question, of course, is why prices, given the incredibly harsh impact on output, why the prices didn't go up further. And I come to the price band with which I think you're now familiar. But there is the feedback from price. If the spread gets too high, it hits biodiesel demand. And I'm going to examine Indonesia's mandate. I'm going to touch, as one or two people have already, on China and its reserve. But I'm going to look at Chinese oils prices, and then I'm going to give forecasts. So I'm trying to do an awful lot. So let's start by looking at prices in a long-term context. This is real prices, real inflation-adjusted palm oil prices. This is in Rotterdam, which is the easiest place in which you can get all the prices of oils. And you can see that in terms of today's money value, palm oil was once or twice up at $2,000 a ton. You can also see that there is a declining long-run trend, rising productivity, competition from other oils which are also rising in productivity. The real price of palm oil fell 1.6% a year. And there is that dotted line. Remember that line, because in my next slide, that is now the brown, the olive-colored, downward sloping line. That is the long-run trend. And I'm showing you monthly prices against trend. The average price in September was 47% above trend. We briefly, and Benny reminded me, apparently I did say I thought prices had come down to 2.2. Well, they did briefly come there, and then they went up again. And they were on trend at that time, and then they've risen above it. Is palm oil unique? In fact, if you look at all the major agricultural commodities, look against the long-run trend in their prices, doing exactly the same as what I've just done for palm oil, everything was above trend. If you want, I don't have a slide to explain this, but if you want my very simple reason, and I'm an economist by training, I believe when you have zero interest rates, in effect, the balance between holding things like commodities as against holding things like bonds, where you get nothing, is biased more to commodities. I suppose if I had to make a forecast after the presidential election in the States, and I hope to God it's not Trump, because don't know what will happen then, but after that election, then interest rates will rise. And I would say in general that's bearish for commodities, because they are all above trend, as you can see. One slide I thought you might like to see is, besides labor, the other big cash cost for you as producers is fertilizer. So I've taken a weighted average of the main fertilizers you use on palm plantations, and I've done it as a percentage of the CPO price. And in this diagram, 100% is the average ratio 2000 to 2015. That's 100%. In 2008, CPO prices collapsed, and the fertilizer producers, which are a kind of cartel, they were able to hold their prices high for a while. And you can see that ratio went way up, above 300%. This time, you've seen that ratio creep up, but most recently, in fact, that ratio has been slightly below average. So in the world trade, fertilizer prices, in fact, have reacted slightly more than palm prices. Fertilizer today is not historically expensive against CPO. So when you're trying to judge prices, and so I'm trying to do the first part of my presentation, looking at the cycle and so on, from 2000 to 2006, if you look back, EU CPO prices, and remember yours in this region, FOB, are maybe $40, $50 below that. They average actually just under $400 a ton over 7 whole years, and at one point were almost 200. Since 2007, they've averaged almost exactly $850. And I think that's largely because you suddenly got the spur to demand from biodiesel. Most people, at least I do, taking a medium-term view, not just 1 year to another, but longer term, expect biodiesel demand in future to grow more slowly. And so if you start to think that we're not going to have an extra boost from biodiesel, then in the long term, if you don't have El Niño shocks, if you believe in long-run trends, which I showed you at the beginning, then you would expect CPO prices, on average, to be closer to the long-run trend. If you could go back, and if you want a copy of the presentation, I don't know if the organizers are making them available on the website, but if not, by all means, contact me. You can have a copy of this. If you look at my earlier diagram, the real CPO price, long run, is in the region of $525 per ton. So let's now come on to the shorter term, really, and let's look at El Niño. And I like this diagram because it really puts the El Niño in context. What I've done is I've taken the Oceanic Niño Index, which is how you measure El Niño and La Niña. El Niño, the son, La Niña, the daughter, and 0 is neutral. The blue line there is going from 1997 to 1998, the last really big El Niño. I show in green 2009-10, which was an El Niño, and actually it did have, if you look back at production of CPO, it did have an impact. And then the red is the latest El Niño. First of all, you see it is incredibly close at the peak to the last really big El Niño. But the interesting fact is if you look at the red line the last 2 or 3 months, which is this latest El Niño, maybe it's not going to go fully downwards, which would be a proper La Niña. So if there is one, it looks just from 2 or 3 months as if maybe it's going to be a weak one. Much more interesting to me, and it's a little bit like the kind of analysis Ivy did, but I'm going to show you I'm even going to go outside Southeast Asia. I want to look at the impact on year quarterly growth. People sometimes say, why do I do year on year? Because you all know there's seasonality in palm oil output. So you should really compare first quarter with first quarter last year. That's exactly what I'm doing here. The green line is for Malaysia, year on year quarterly output growth. From 1996 all the way to 1999. That's the green line. And you can see the recovery was incredibly strong in year 4, which was 1999. The blue is this El Niño. The blue is pretty good in tracking the last El Niño. It's slightly below, but that doesn't surprise me because the underlying growth in yield, in area, the slower arrival of new, maturing, higher, increasing yield areas, we know that there's less expansion in Malaysia than there was then. So I would say just to begin with, the last El Niño is a pretty good starting point for what you might expect this time. I then make a stab and we do something a little bit like what Ivy was showing, but we try and go beyond the public companies to make an estimate of production for the other companies also, everyone in Indonesia, allow for changing age profile, everything that should be there. This is our best estimate of the quarter on the year before growth in what's been happening in Indonesia in red. And the green, I have to use Malaysia because that's where we have the data. So I would say Indonesia is a bit similar to Malaysia last time round. Maybe you would say it's been slightly lower on average than Indonesian growth this time than in Malaysia, but maybe it's slightly closer to last time than was the case in the slide before. So far it looks as if there is some nice similarity between last El Niño and this one. This is our quarter by quarter, together with Ling Ah Hong, we try and do forecasts going out up to 2 years by quarter. And if you look at the dotted blue line, that is our Malaysian quarter-on-quarter forecast. And actually, this is, I think, fairly in line with what people have been saying. The first quarter next year, you can see we're not showing any year-on-year growth, the blue line, and then it picks up. I've just spent the first 2 days this week speaking to Indonesian plantation people and getting the best sense I could of to how they are doing. They are getting a much stronger pickup year on year in their output. They went down a lot, but they are getting the pickup slightly ahead of you. That's my distinct impression. And of course, you've got the new maturing areas coming on stream. So the peak growth from admittedly an incredibly low level. You mustn't forget these are percentage growth and they can be from a very low level. So don't be too shocked by it. But we see the big year-on-year percentage growth in Indonesia happening earlier than we see it from Malaysia. And the green again is what actually happened in 1996 to 1999. Just for interest, I thought I can get data, we get data from other countries. So here I'm comparing Malaysia with Thailand. So imagine going up right to the Kedah towards, go further north, and you're getting drier area. The right-hand side measures, for the last El Niño, Thai growth, and the left is measuring, this is now month on month, Malaysian growth. Basically, Thailand, maybe not a surprise, was following Malaysia. But look, the scales are 4 times as big. When they swing, they really swing. Much, much more than Malaysia. Well, what about this time? We also have data from Colombia. We have Thailand, and we have Malaysia, all of them monthly data. And I'm showing this El Niño, and I'm showing Malaysia in green, Thailand in red. It actually went off the top of the scale. Yellow is Colombia, which is far, far away in South America. Note that the Thai and Colombian scale now is twice the size of the Malaysian. What you can see is in places with drier, that are inherently drier, you seem to be getting now maybe twice the swings you're getting in Malaysia. But the El Niño pattern is clearly universal. I'm hurrying because I'm aware there's a clock down here. Now I'm going to show you half year on half year, including forecasts into the whole of next year, of half year on half year changes in world CPO output. Blue is Malaysia, and you can see we're expecting a decline this half year in Malaysia. The yellow color is Indonesia, and the red color is Thailand, Colombia. We also have data for Papua New Guinea, and that's really most of the world. You see the huge deficit first half this year, over 4 million tons, still a deficit this half year, year on year. Big recovery first half next year, around 4 million. Another recovery not as big in the second half of next year. We are having, as those figures I was showing you, dotted lines of forecasts, we will have, as is normal, a recovery. It's worth noting, however, that we are nowhere near where you might have been expected at normal yields. If you go back to 2012, the last really decent normal year for palm output, this recovery, is not doing much more than to make up for the loss we had last year, or the current year, So, to summarize this, in terms of the ONI, which I showed you, this El Niño's as bad as it was 1997 to 1999. And you saw those growth rates were similar in for Malaysia at least, and I showed you also Thailand, there is a similarity in patterns. I put in italic because we all know that Indonesia is very hard to understand what really is happening. I just note that where my colleagues and I show a fall of nearly 3 million tons in the first half of this year in Indonesia, and there was another loss in the third quarter, the gap key figures actually show a loss of only 1.1 million. I think that in the third quarter this year, there's another output decline of about 600,000 tons year on year in Indonesia. But after speaking to people, and anyhow it was already our numbers, we have year on year growth of about 400,000 by the final quarter this year. Peak production may be in November, which would be unusual, but it's certainly picking up in October. But the first half next year, you get the big jump year on year in output, which is to offset what happened in the current year. All right, let's now come on to prices, and this is the price band. I think by now I don't need to explain it. Crude oil at the bottom, dollars per ton in Europe, and then we have palm, which on your diagram's black, and then we have red and green, we have soy oil, rapeseed oil. But the key point is the spread between crude oil and the vegetable oils, especially the one that matters is palm, has got wider than it did for about 2 years or so. This shows you premium. This is the spread in Europe of soy oil in red, palm oil in green over crude oil. And the dotted lines are the average since 2007, which is really when biodiesel started to have its effect. And you can see the premia are higher than they normally have been over this period. So they're unusually high. But they are not as high above zero. The premium's not as big as it was back either in 2008 or in 2010-11. One thing people always talk to me about is, oh, but palm oil's no longer correlated with Brent. Well, it shouldn't be, because there's a price band. It fluctuates inside the band. But still, I went, and just since I was meant to look at the commodity cycle, I thought I would show you the correlation coefficients of the monthly prices over the last 10 years, since biodiesel, biofuels began to have their effect on a whole range of commodities, their correlations monthly with Brent. For soy and palm, I highlighted palm in red. The correlations are the two highest among all these commodities. Maize is another biofuel. Biofuels are important also for maize in the US. So you can see that palm is definitely among the commodities where over time there is a higher correlation with Brent crude. What determines the premium of palm oil over crude oil? I think you gather by now, I see the palm oil price as crude oil, so I'll say a little bit about Brent, crude oil plus a premium. The premium, which is shown here in blue, measured on the left in dollars per ton in Europe, is inversely negatively related to MPOB stocks, which are measured in red. And I went to check just before coming down for this presentation where the premium was today. So I've just added that to the diagram. It's today about $325. But you can see that they go in opposite direction. But one thing which I would like you to remember when you're looking ahead, I think the market has started to look forward a little bit more than it used to. I hope maybe conferences like this educate people not just to look at today's stocks, but to think about tomorrow's stocks, to think about what's going to happen. And I would just say that because the premium never fell as much as you would have expected on the basis of record high stocks. This is going back earlier this year. Late last year, around September time. Stocks went above 2.8 million, and yet the premium never fell to zero, which it would have done otherwise, because everyone knew about El Niño coming. Indonesian biodiesel was another factor which I'll come to. But the premium never fell to zero. Now we're in a period where we know production's going to be recovering. Everyone agrees about that. So we know that stocks are going to go up. The interesting question is, we're in a period of low stocks. Will people behave like they did just 6, 7, whatever it was, more than that, months ago, a year ago? Are people going to behave like they did then and look ahead, not just look at where we are today? Other factors affecting CPO. One important one is the spread between the soft oils and CPO. CPO, this is daily prices now, Rotterdam, the spread. The blue is sunflower oil, the green is soybean oil, and the red is rapeseed oil. You can see that within the last, I don't know, 2, 3 weeks, there was a very brief period when sun oil and CPO were actually the same as one another. The other oils were keeping palm under control, stopping the price from rising, because the spreads vanished and importers could switch to other oils. In the last week or so, and the last value is, I think, from yesterday, because I did this early this morning, you can see that that spread has widened quite a bit, just in the last week or two. But in the background, and people have mentioned the Chinese reserve and the sale from the reserve, China mustn't be forgotten. Here I am showing you 4 lines. The red one is the price that the Chinese got up until June when they auctioned. It was actually almost exactly 2.25 million tons. The figure of what's left, the figures I have from my Chinese colleagues, are a little bit higher than Ivor's. We reckon there are 4 million tons left. But they sold off 2.25 out of 6.25 million tons. And you can see, this is all in renminbi, you can see that they were setting a fairly flat floor to the price in red. The green line was the free market fresh rapeseed oil, much better quality. The brown line was the soybean oil. These are all in coastal provinces, so they're the right prices to look at. And can you see that the flat rapeseed oil price for the auction seems to have kept a flat trend in rapeseed and soybean oil prices in China? They crept up a little bit. The fascinating one is olein. Olein in blue went from being much cheaper than the other oils. It caught up with the auction price, and then more recently, in fact, ever since the first, and I checked, these are prices up until yesterday. I mean, we had a gap for the Golden Week, but these are, yes, including yesterday. Palm olein is at a premium over those other 2 oils in China now. Palm is not a cheap oil. What about biodiesel? Indonesia is the big one that you look at for biodiesel. What I show you here, okay, there's a calculation in the background, but we know the formula for how biodiesel is priced under, they call it a mandate, but it's not a fixed quantity. They have a pot of cash, and if the gap between CPO and Singapore gas oil gets wider, then they cannot subsidize so much. That is what I'm showing you here. I'm showing you here I'll show you 2. One is $45 Brent crude. I then add in my formula the premium for gas oil, but you don't need to worry about that. $45 Brent and $50 Brent. And I've taken $700 FOB Southeast Asia CPO. So on the basis of that, I have shown you, these curves are showing you the trade-off. Along the bottom, I have the different FOB CPO prices. As the gap gets smaller, as CPO comes down, Indonesia can afford to subsidize a bigger quantity of biodiesel. But at $700 CPO, which is not far from where we are, if Brent is $45 a barrel, which is where I think it's going to go, then you could only fund just over 2 million tons of biodiesel in Indonesia. If Brent stays at $50, and it's drifting down at the moment, then you could fund 2.35 million tons. Indonesia, and I don't think they ever thought about this, but I respect them greatly that they have invented a stabilizer of sorts into the palm and vegetable oil market worldwide. If the price were to fall to $500 FOB, if it went really down, and if we had $50 Brent, Indonesia would have enough money to subsidize over 6 million tons of biodiesel. That's pretty impressive. And that was done because of the way they're funding this. So, actually, I'm doing okay. I think this is the last slide. So the outlook for CPO prices. I do not expect Brent to remain at $50. Partly, I don't believe OPEC. This is normally a time of fairly high production of crude oil. The Russians have reached an all-time peak in their production. They're perfectly happy to say they're going to stop here. But that's not the only reason why I'm skeptical, because I don't think they've got their act together. The other reason is, lurking in the background is US shale oil output. If I'd known I had a little bit of time, I would have shown you some nice diagrams I was doing also early this morning of the number of rigs drilling for shale oil in the US against the WTI price of crude oil, with about 4-6 weeks lag as the price of crude goes up. And I was looking, there's a fairly nice carry in the futures for oil in the States. If I were one of these shale oil producers, and some of them are now with production costs well below $40 a barrel, I would be locking in prices and I would be resuming production in areas that I'd stopped producing in. I'd be hiring more rigs and getting back into the business. So I don't believe that $50 will be sustained. So I put $45 into my forecast, but I do allow, as I say at the bottom of this slide, what would happen if it was $50. The other thing I hadn't really reckoned on is what's happening to the ringgit. I don't know if there's a 1 MDB thing in the background or something, but I see it was, I just was looking before, it was over 420, so I don't know what it is this second. But I think when I did this, I was thinking something more like 414, 415. But anyhow, I believe that what's going to happen, partly because we're still on the upturn in, just on a monthly basis in production. So stocks should rise for a month or two. I think because of higher stocks, CPO is going to settle in Europe at 675, 700 towards the end of this year, which means if you're thinking BMD, I've got the wrong exchange rate here, so you should add a bit on the ringgit. And I've tried to factor in the export tax. Malaysia is no longer so easy just to make a simple calculation, but I put 2.4 to 2.450 BMD. But then, and I think people agree, because production will fall in Jan-Feb and MPOB stocks will fall, and so you're going to see some pickup in price. But don't forget what I said about the market. I believe is becoming more rational. It knows we're getting over El Niño, and it knows that there's going to be an avalanche of new palm oil output arriving year on year. So I think by the second half of this coming year, prices, the one you care about is FOB. The price FOB will be more like 550, which means, depending on your exchange rate and the export tax, I put 2,100 ringgit. And this is because Southeast Asian production, and that elsewhere, will be recovering from El Niño. I thought I should just tell you, if, however, Brent doesn't go to 45 but goes to $50, you should add something like 150 ringgit to these forecasts. So with that, I'm still on time. Thank you very much.